Guys, I want to welcome you to another episode of the Advisory Board podcast, where we bring in experts from around the franchising community to help you build brands that will last, that can thrive, regardless of how economic times are going. I've got a guy with me. You may or may not know Ron Davison. He is the Chief Revenue Officer over at Jumpstart Financing. Ron, say hi to everybody.
Hey, how you doing?
And guys, if you don't know Ron or Jumpstart, I want to tell you a little bit about him because I brought him in. Maybe you've noticed that the financing has gotten a little tougher the last 18 to 24 months in this industry. I know brands that literally could have sold five, six more units if they had available funding that could have gotten them the right amount of money or money and time for a deal to happen. And so Ron and I were talking, and as we were discussing some of the creative ways they're helping people find financing, I was like, we got to record this. So Jumpstart is they're kind of leading the way and challenging the funding space a little bit. Most people are familiar with like traditional funding, and they've created their own private Jumpstart loan program that's really rivaling these other programs and giving people more flexibility. You use the word concierge, and I'm going to say it here because I thought that was brilliant. But they're kind of more than just like, well, we'll process a loan robotically. They're kind of a concierge service of financing, so they can help people get creative, piece different types of financing together to get people to their goals. So I think that, and Ron, personally, you've been doing franchise funding for what, 20 years now? Is that right?
Yeah, yeah. 20 years I've been doing it.
That's wild.
Love franchising.
It's hard. It's like
Nice.
you can't get out of the orbit, right? You get kind of sucked into it. So you always kind of stay orbiting franchise.
Yeah. It's a small
Uh,
world. Yeah.
it is, and good people. So I just a couple of fun things about Ron you guys should know, and then we'll jump in. I want you to tell us more about yourself. But Navy vet, thank you for your service. And Ron was also a championship swimmer. There's another story there, but I'll let you tell if you want. And then he's into free diving. And if you don't know what that is, it's kind of nuts. But like big gulp of air, and then they'll just take off and swim to the bottom of some like sinkhole in Florida, spring water, and like he can go down to 100 feet deep, which I think is nuts. So Ron, let me stop you, Amber. Tell us more about you. Tell us a bit more about Jumpstart, and then we'll dive into the topic in more depth.
Thank you. Nice opening, yes, I do love the water, growing up in the water and swimming in college and stuff. As you get older, you kind of look for ways to challenge yourself. So free diving was that venture way of getting into nature for me. But entrepreneurship, business ownership, helping veterans, helping franchisees, helping people buy a business is a passion. The tech side of things and getting creative and helping people find a way to get into funding where banks are kind of shutting them down and getting creative paths set for them. It's interesting, Like you said, last 18 to 24 months, a lot of doors getting shut, trying to get creative and figure that side of it out. Jumpstarts really come together. We merged. It was a merge of unsecured funding source and all cap funding, which myself and my business partner owned all cap funding, and we got approached by a competitor, UFS, to you know get together, look at funding strategies differently with direct lending, different types of loan products. And we launched the brand in September with the idea of going towards, our own direct lending, our Jumpstart proprietary loan, that in-house direct lending that we're doing to try and, cut out some of the red tape, some of the stress involved with lending, unsecured funding, quick access, 1 to 2 weeks. So trying to kind of shorten the stress cycle with getting people access to funds while still providing them all the traditional options that may still fit, not one size fits all. So we're looking, like you said, a concierge service, do we need to get somebody a home equity line in addition to a term loan, or is an SBA loan the best fit for them? Is our in-house lending? But finding what's the right path for them instead of thinking inside the box, we have our loan advisors think outside the box and, find the right way to get somebody into business.
Yeah, I love that. Well, let's live outside the box a little bit, but first we're gonna start in the box. Tell us as we jump into the topic. So essentially, guys, in a nutshell, we're looking at what are some creative ways you can help finance franchise acquisition, or even owners that need to recapitalize, owners that want to expand, that want to buy new territories, that need new equipment. Like there are 100 reasons why a business owner needs capital, sometimes to make payroll, but we hopefully aren't we there. We aren't there because that's a rough place to be. But Ron, tell us what would you describe as kind of the pillars of traditional financing first, just to lay a foundation. Then let's shift gears and tell us more about like what is private lending and how does that work and why is it different?
Yeah, so traditionally to get into business, you're going to look at cash, right? Do you have your own cash? Can you just
Mhm.
self-fund it? Don't need a loan, don't need to take on debt.
Mhm.
Cash could be your own money, family money given to you. You could use your retirement funds. You've left your job or employment's ended and you have 401k built up. You can roll those over into a Rob's program to avoid penalties and, tax implications and stuff, and then leverage those to start a business. Fairly common in today's market. When you're getting into other people's money, OPM, you have traditional SBA loans, right? Government-backed loans where the government will back a portion of that with a lender, and then they're willing to give you startup capital to get into business. Um, Typically from 150,000 or more, a lot of lenders don't want to go under 300,000, 500,000 for SBA. So the smaller loans become more difficult for SBA.
Mhm.
And then you have unsecured funding, which is that under 250 realm where we operate a lot in, and HELOCs. That's the typical way you're going to fund the business. Those are the strategies most people are using to start a franchise or buy an existing business.
And I know rates have been a little bit outlandish the last few years as far as lending is concerned. I mean, you've been doing this for 20 years. When
Yeah,
was the last time we had SBA loan rates that were in the double digits?
15, 20 years, maybe a long time ago, even longer, maybe.
Yeah,
Rates weren't that, it's rates have been low for a long time. To see rates like we did even 5, 6 years ago, we're probably never going to see that again in my lifetime. 0% rates on buying a car, 0% for 72 months. Those days are probably gone. 2.75 home loan rate, unfortunately. But
I know. Yeah. I will never refinance my home with a 2.99.
right, exactly.
There's no way. There's no way. But yeah, I appreciate that. So let's talk about, so there are challenges and there are benefits even for these traditional financing tools, and I don't want to dog on them all. Tell us, like, what are reasons why someone would want to use some of these traditional tools, and how do you see people using them creatively? Because there are like creative ways to use a HELOC and traditional loans, unsecured loans. But you mind sharing a little bit about like strategies? Because this is really a strategy discussion. Like financing should always be strategic. So how do you see people using more traditional lending methodologies in more creative ways?
So it's a great question. We had a good conversation with 38 different brokers today that we were working with, kind of strategizing on some of these creative methodologies, right? So, or even like using their retirement funds to roll over into a Robs to take those funds and do a cash injection into an SBA loan where they don't have the liquidity, but they have it in their retirement. So leveraging programs together, stacking programs together to find a creative way where they don't have everything they need in their retirement. They don't have the cash injection to do the SBA loan, or even doing a HELOC to then leverage that to get the cash to get into an SBA loan, or unsecured funding to get the cash to get into an SBA loan. And that's just speaking of trying to get into an SBA loan, right? You may need to go a HELOC and an unsecured loan because SBA is not an option with the brand you're looking to buy. So there's different caveats that go into each situation where looking at everybody as the same, you're never going to do that, right? No one's going to ever fit into one box. You oftentimes have to get creative and approach it with a different mindset to look at what's your affordability, where do you fit, but also aligning with the client. Some clients are going, it's SBA. That's how you start a business. That's the only thing I will ever look at, and that's fine. We can take you down the SBA route and explore all of that. And then at the end of the day, if it doesn't work, we have alternative options for you, right? And show you different paths that you can take to get into business. So,
Yeah. Well, I mean, I'd love to stop there because most people that I talk to, like, oh yeah, SBA, you should do an SBA loan. It seems like everyone's kind of fallback, but it's kind of a problem, actually. At least it creates a lot of friction in the buying process. I'll share two quick examples. One is myself and one is somebody else that I know that was trying to buy an existing franchise, and it took him 6 months to close on that loan. It was ridiculous. 6 months on a very profitable, good business that was being, purchased at a great price, had some upside in the actual purchase price. Like everything was working, and yet it didn't work. Our own process was we did a small loan. and to get working capital for buying a couple of territories of a franchise. And I will be honest with you, like I was so disgusted with the process by the time we were done. My wife was like, "We will never, ever, ever do an SBA loan again." And I was like, "Yeah, you don't have to tell me. I would never touch it with a 10-foot pole." And it's not because they're bad or evil or anything, but because the process sucks. Like if you are doing anything we need working capital from the loan, which is the process that we were going through, it's not really, even though that's like the headline of what it's supposed to be for, that's not actually what they're suited to do. And I felt like I was getting cross-examined as a criminal every time I asked for money from the fund. And I was like, wait, this is my money. And they would not let us have it. And it was a nightmare.
Yeah.
Yeah, so businesses that are high cash flow, like we need to pull some out and then pull some out, I would strongly recommend not using an SBA. But if you're like, I need a big chunk of money up front to pay for something, it works pretty well because then they'll actually let you get your money and it won't be a fight the whole time.
Yeah, and on those larger loans, on those larger deals, SBA is kind of the route that you need to go a lot of times, where unsecured HELOCs you can get up to 400, unsecured you maybe 50 to 500, or if you're stacking some of those together, you're going to get higher amounts and stuff. But
Yeah.
unfortunately, sometimes over 500, you're going, well, I just need to go the SBA route, where with our Jumpstart loan, that as we're gaining liquidity in that, we go up to 250 now unsecured. We go over 250 secured. As we gain more liquidity, we're trying to get those numbers up to being able to hit some of the higher dollar amounts where they're struggling.
Hmm.
Emerging brands, right? How do you fund an emerging brand that only has a few stores open, but it's a great concept, great ROI, good
Yeah.
FTE, good projections. I mean, and you got a strong buyer in there. How do you get an SBA loan for something like that when they won't touch it? You got to have alternative options and find creative strategies to get them into business.
Yeah.
They're getting vetted at the franchise level, they're getting vetted at the consultant level, they're getting vetted by us, our underwriting. By the time they even make it to the bank, we're bringing a significantly qualified candidate to them. So it's interesting when you get
Yeah.
that turned down.
Yeah, I love the approach. Talk to us about private lending because a lot of people aren't really familiar with what this means. How do you guys have your own in-house loan tool and product, and how is that different than these other tools? And how do you guys vet brands or opportunities? I'm just curious if you can lay that out for everyone to understand, because I'm guessing most people understand what HELOCs are and these other tools we've talked about today.
Our Jumpstart loan is it's our own in-house direct lending. We have a sponsor bank. We have a few $1 million that we lend on. We're looking at specific underwriting requirements to mitigate risks. We're looking at the FTD. We're looking at the franchise brand. We're digging into it a bit more on the owner side of it. It only takes about a week or 2 weeks to go from starting the loan, looking at the franchise, looking at the owner, getting into the financials. Really, it even goes to a loan committee inside our board and our staff and stuff. We sit down and we go through everything from front to back with it. But there's not a lot of the red tape, business plan, projections, a lot of things you have to do for all the hoops you got to jump through on the SBA side of it. So where it's much different on that end of it, it's still a 10-year term.
Mhm.
Rates are decent. The monthly payment is good. It's just a much quicker access to the capital, and you get a team of human beings looking at it, being almost logical, but financially looking at this, going through it and understanding the client to make a good sound decision on it and not just having a cookie cutter box that it needs to fit into, right? I think we're trying to disrupt that side of things and think outside the box and find people that we can help.
Yeah, I love it.
But it is our own funds we're lending out. And as we gain liquidity, then we're going to hopefully branch off into different sections and break part of those liquidity chunks out to be able to develop even further programs with franchisors directly and stuff to kind of disrupt that market a bit more.
Yeah. No, and so do you underwrite brands? Like do you like let's say you looked at Dave Hansen's franchise brand. I'm the franchisor. Do you actually qualify that franchisor and say, "Oh, they've got the FTD looks good, item 19 looks healthy, they've got proper staffing and support to make sure this owner is going to be successful." Like how do you vet the brands so that they can be they and so those who are listening can say, "Oh, I should probably get these ducks in a row so that I could send my franchise candidates to Ron and team and get one of these loan products that is a better fit for them."
Yeah, we are looking at the brand. We're getting into Fran data as well. Industry, you
Mhm.
know, partners of ours in the industry will dig into a bit, reach out, have some phone calls if we need to. If it's an emerging brand, we may know people at the brand. We can call and get some more insight, reach out to Fran data and gather data on the franchise itself.
Yeah.
Emerging brands are tough. What data do you have? But even in an emerging brand, if you're looking at someone who's buying a restaurant, but they're coming from corporate America, it's a tough sell an emerging brand at a lot of banks. But if you dig into the person a bit and look at their assets, look at ways to mitigate those risks. Maybe they do have property you can tie and make it a secured loan and mitigate those risks a bit, right? Take a risk on someone, but you have to look at the individual as well and not just the brand, right?
Yeah, but it doesn't. The brand does matter. I guess that's the point I want people
Absolutely,
to
yeah.
get.
The brand does matter. We use Fran data a lot, and reach out to the brand if we need to directly to get any information we need.
Yeah. And are there a couple of key metrics that are like the most important for you guys as you're vetting the brand for eligibility?
How many do they have open? If they're one location open, they're under 5 locations, or under 10 locations, or under 30 locations.
Mhm.
Our CEO and my COO, are looking at that pretty aggressively.
Yeah.
Um, just like with any SBA bank is going to look at that with an emerging brand, but we've had some that were emerging brands that were under 5 units open, but looking at the matrix on it, the ROI, as far as what they were producing, their flagships, how many outside of that were actual franchisees, what are they doing now?
Mhm.
Talked to one today that's, gosh, I mean, they have 30 locations open, but they're all been opened in this last year, right? It's a real emerging brand, but it's on fire right now. But it's interesting that they're averaging, like, projections say it's about 650 a year with 35% profit on it, which is pretty significant. I'm like, oh,
That's
interesting.
healthy. Yeah. Mhm.
Yeah.
Ultimately, you're trying to assess, does this concept generate enough cash for the investment that it's required so they can pay their
Right.
loan and afford to live, right?
And afford to live too,
Mhm.
right? Like, as a kind of rule of thumb, a lot of SBA lenders will say that they need to say that on average, the average household needs to have $50,000 coming in to cover basic expenses, right?
Mhm.
At a minimum, is their spouse covering it? Are they covering it? Do they have a year's worth of savings that they can get by as they ramp the business up?
Yeah.
What cash does the client have saved in retirement or cash on hand?
Yeah.
Helps.
I love it. And so, but let's talk about individuals, right? Well, let me take a step back. We've been talking about a couple of instruments that are really good for smaller investment amounts, right? So home service brands and things like that. I want to shift in a minute and let's talk about the bigger investments like restaurants and retail and things that need build outs and have real estate. But for a lot of these smaller loans, there are a lot of people that don't want to play ball in that space. So but there are some other ways you can leverage maybe some jumpstart funds and others. Why would somebody want to have maybe a couple of different finance instruments as part of a total funding project versus just a single one? Are there advantages to doing that?
I think people would all want one single loan for the
Mhm.
most part, right? But sometimes you have to get an equipment loan because you're buying equipment, then you get your working capital loan. So sometimes you're stuck getting multiple loan products if you need to. But a lot of it comes down to the bank's requirements. Some banks will max out at 50,000 in a term loan. We're leveraging personal term loans, business term loans. So, and they have specific requirements. They have specific debt to income ratio requirements, but they're going to box you in. If they're only willing to give you 50,000, that doesn't mean you can't afford more. That just means that's all that bank is willing to issue a loan on. And you may need to stack two, three, four loans together to get into business,
Mhm.
within reason, right? If you're just stacking a bunch of debt together and it becomes bad debt and you're not able to maintain that and operate the business appropriately, then, or lose the business, then it's not good either. So within reason, you can stack loans together and still get into business.
Mhm.
It
Yeah.
gives you a competitive advantage against the banks and things outside the box, but you have banks specifically that will lend. If, as an example, you could own 100 homes outright and have rental income coming in, but you don't have a mortgage on your credit. Some lenders are going to consider you a renter. They're going to give you higher rates. They're going to cap out how much they're willing to lend to you just on a term loan. Maybe you only cap it at 50,000. Where if you just had a mortgage on your credit on one of those properties that you own, now they'll give you 100,000 or 200,000. So their matrix and how they view you is completely unique to what's in your credit oftentimes.
Yeah.
So
Well,
it's interesting.
well, and
Yeah.
you got people that have founded and exited successfully, maybe multiple times as an entrepreneur. They don't have like a W-2 income. I remember where that was almost insurmountable, right? If you didn't have a regular Joe job, you couldn't get loans for a while. It was hard to get a mortgage. It was hard to get any sort of funding. So how do you help people work around that? Because a lot of these folks that are buying franchises, they are entrepreneurs. Maybe they own another business and now they're buying another one. They want to have them synergize together. What are some of the ways that entrepreneurs can make sure they're eligible for some of these tools also?
So it's a good question. Self-employment, they're gonna tax you like 2 years in business, what's passing through to your personal taxes before they'll even consider it income, right? W-2, you just need two pay stubs and all of a sudden you're employed, you have income, you're valid. When you don't have that W-2 job, you can look at SBA options if you have the cash injection, if your spouse is covering the living expenses, or if you have 12 months of living expenses stacked up, you don't necessarily need to be employed, or you look at the ROBS programs, right? For unsecured funding, your spouse can leverage their credit and income to acquire the business. They don't need to work in the business or own the business, but they can leverage that side in your home, right? You can be out of work, but wanting to start a business. Your spouse can then acquire the funding for the business and fund the business. So there's different creative ways around that, but not a lot of options where you're just using the future projections of the business that you're buying if you don't have enough liquidity stacked up, right? There's not a lot of options out there for that still. It's still heavily income based. But if you don't have a job per se, but you have rental income or you have pension, military retirement, or disability, so there's a lot of other things that are still driving income into the home. They all still matter. They all still count, right?
Yeah, awesome. Well, so tell me a little bit, Ron, about where people should go as they're trying to get enough money to buy like a restaurant. These are very different challenges. Funding unless it's like a home serve, like a dumpster business where you need quite a bit of capital to get started. I need, 8 dumpsters and 2 trucks. Like that's a lot. But otherwise, home services tend to be on the lower investment side of the spectrum. Moving up, not even up market, just into a different industry, there's a lot more cash outlay. So how do the strategies change when I'm trying to get funding for a larger investment amount?
Right now, SBA is where the larger investments have to go, right? If you're looking to start a restaurant, and you need a lot of capital, you're gonna get that in chunks, like what you saw, right? You may get a portion of it when you're getting the loan done. They're not going to disperse funds until you have your lease picked out, your lease option, your letter of intent, right? So there's different milestones in there where funds get released to you. So it's a little bit different, as you said. Hearing you say getting down the road and needing access to your own working capital and like getting that difficult wall put up in front of you is interesting. But we hear that a lot as an alternative to SBA for a lot of what we do on the smaller end of it. We hear a lot of the stresses on the SBA on the other side. But as you get into the higher amounts, I mean, you're really kind of stuck into that SBA bucket where you kind of have to go that route, or you're tapping into your own retirement. Some
Mhm.
people have larger amounts of retirement they can roll over and leverage those funds or their own cash.
Yeah. Well, and I've got a question for you about that. You mentioned, like loans for equipment loans specifically
Yeah.
earlier on. My understanding is, and I'd like you to correct this if it's wrong, sometimes it's actually advantageous to get equipment loans over just like and split that out rather than doing finance like a big lump sum financing through SBA. Let's say you got to buy a bunch of like capital equipment for a kitchen or a vehicle of some sort. Sometimes is there an advantage to using the financing tools that are provided from the equipment manufacturer versus going through a large scale loan? And how would you recommend people approach that?
It's a good question, and it depends on the strategic relationships, in my opinion, right? If you're going to need a vehicle, if you're going to need certain, type of major equipment like that, where like the neighborlies of the world might be looking at, they have a strategic relationship with the dealership that's going to help them get their vehicle. They may have better pricing and easier time getting the vehicle that way. They're going to need to get the vehicle wraps and different stuff. So there's a lot of strategic relationships that a franchisor may have on their end of it. Um, Equipment financing too. I mean, some of it's just preferred vendors, preferred relationships that they're leveraging on that end of it.
Mhm.
And sometimes you are getting it all done in the loan, right? If you're getting everything funded at once with your unsecured funding or HELOCs and you're just buying everything outright. Advantages on equipment, I would say is probably not my specialty. We don't do a lot of equipment financing. We see a lot of that being done at the franchisor level or before they even get to us.
Yeah.
But it is a topic of conversation that we're growing into on our side too. So we'll see. More to come.
Cool. Yeah, I was chatting with somebody about it earlier. The reason I brought it up because I remember him saying that there was something about getting an equipment loan that it impacts like your business credit very quickly. And then if let's say I bought a truck, and then after let's say I pay that truck off in a couple of years, or I just need a new truck after I think it's 12 months with an equipment loan, and that's where I was hoping you might be able to guide me. But I could,
On
Jonathan.
the business credit side of things,
Yeah, on the business credit side of things, they'll if you paid for 12 months on an equipment loan, usually that lender will be like, oh, no problem. You want another truck? Cool. Like there's almost like a streamlined process depending upon the lender and the equipment type to expand.
yeah. I can see that as you're developing relationships, even certain banks that we work with, if you get a loan, over time, you're going to get better rates and terms, you can access more capital. So you're developing a long-term relationship with the lender.
Mhm.
And business credit is very unique, it's not like personal credit. Not everything reports.
Yeah.
Where if you're on a net 30 invoicing system, but you pay that early every month and that gets reported to business credit, your business credit score goes up.
Mhm.
Where with you pay your credit cards early, your scores don't necessarily go up, right? But if you pay your business credit early or twice a month, pay your debt twice a month, and now it shows you pay twice a month, so you're paying early, and if you pay $10 more than the minimum, you pay more than the minimum every month, twice a month, you
Mhm.
pay early, and then your scores go up and up and up more rapidly, and you can develop that business credit. It's interesting. A lot of lenders don't weigh heavily on the business credit like they used to sub or pre 2008, but seems like there are some still relevant sides to business credit.
Yeah, and I think it might apply a little bit more when you're getting like larger loan sums where they're like,
Yeah,
well, what type of a business am I dealing with here? But a lot of the smaller loans are being personally secured, so it doesn't really
exactly.
affect. And people don't have business credit too. That's the other thing. Like average Joe Blow who's going to go buy a franchise, I didn't even know business credit was a thing actually for a long, long time. And so then I was like, wait, there's a thing that's called business credit. Why do I care? And I was like, oh, now I get it. Like I'm not going to go out and be able to secure the type of financing I want if no entities acknowledge me as a legitimate business. I get it now.
Right. Get your paydex score up, get your Dun& Bradstreet stuff in order, and which they're a business too, right? It's interesting. There's a lot you can do for free on that side of it, or you go down the rabbit hole of all the people trying to sell you stuff to get your business credit going. Always
Yeah,
interesting.
that's
It's a
true.
game.
A lot of it is, but the rules of the game, it's not scary anymore, right? Um,
Yeah.
Ron, this has been insightful and helpful. I hope the guys listening in are taking some notes. What if you were to summarize, like maybe let's take a step back and look at a couple of things today. If I'm a franchise brand or I'm a consultant and I've got a candidate that really is interested in buying a franchise, what are a couple of things that you would recommend they start doing now before they even get to the point where they got to start applying for loan docs? What should people be doing to get themselves ready so they're in a good position for financing options?
Good question. So it's changed a bit, right, over the last 5 years, couple of years, where depth of credit didn't matter before. Do you have diversity of credit? Like if you don't have a single credit card, you have 830 credit, unsecured lenders aren't going to touch you, right?
Hmm.
Too thin a credit. So having sometimes even just an authorized user card added from your spouse added to yours, get your depth of credit, get your utilization down under 30% on your credit cards if you can. Don't just pay off a bunch of your cards and then close them all out and try and go get a loan, Consult with a finance professional.
Mhm.
Like our team as our loan advisors are, like you said earlier, concierge approach, but we get a lot of people that I just left my job, closed out all my credit cards, paid off all my debt, I'm ready. Right. But if you talk to me right before you did any of that, you could get all this funding. Like you just shot yourself in the foot. So I would say
Mhm.
consult with someone like whether it's our firm or another firm, consult with someone you plan on getting funding from, have them evaluate your situation. If you're not just applying at a bank and you need the loan, before you go in, you can adjust your utilization ratios under 30% overall. If you can do that on credit card utilization, banks really like to see that in today's market.
Mhm.
But if you do have the opportunity to talk to someone, have them look at a credit report without pulling a hard inquiry on your credit, get their opinions on things,
Mhm.
have a conversation, then make whatever adjustments the finance person directs you to do to get the loan you're looking for versus making a lot of adjustments and then going in, unless you're just applying at a bank that isn't going to have that conversation.
Awesome advice. Wise too, because it's a lot of people have that tendency like, hey, I paid all this stuff off, I'm ready to buy, but they just destroyed their credit history. And
Yeah.
anyway, it's ironic how that works. It's almost backwards. Some of the stuff that they use in the credit monitoring, like I don't think that's a
Right.
lot,
Yeah.
but I'm not the guy who makes the
I'm
rules.
power. I don't have any credit card debt. I'm a perfect candidate. I make good income, but you have no depth of credit. They won't touch you. It's
Mhm.
got to play the game. Unfortunately, you just got to take their game and play it against them.
Yeah, know the rules, right?
Yeah,
Uh,
exactly.
so let me circle back to one more thing as we wrap up on this, and maybe this is our final thought today. Private lending, like the Jumpstart loan program. This is something you said it's starting to. You guys are kind of trying to revolutionize the way people do funding. What should people expect? Is this a trend? Do you think people are going to start seeing more and more of these like private funds popping up in franchising because it's such a consistently successful business model? Or what's your take on that?
Private lending, I think, is coming. It's a disruption. The banks, are only able to do so much. Private lending is entering the small business lending market, wanting to enter it. Where they're, I think, struggling with a lot of private money is they're wanting it to be too high of a cost, where our banking relationships that we're navigating are able to keep the costs a little bit lower. So that's where we're able to more disrupt the market by offering better pricing on the money. But private money's coming. There's a big push in private money right now in the personal loan space, in personal lending, in business lending.
Mhm.
So you'll see it. It's coming. It's being talked about on every financial forum you're going into.
Mhm.
A lot of our things that we're sitting on and just in the overall financial well-being of America and what's going on. Private lending is a huge source right now. So, and they're pushing into the market. You see private equity pushing into franchising everywhere, not pushing in, but helping and growing, right? Partnering with franchising, not
Yeah.
pushing in may not be the right term, but there's a lot of great private equity firms that have partnered with a lot of brands in franchising and really helped them scale and grow. And that's, private equity, private money coming in,
Mhm.
but private lending is coming too. And we're trying to be the forefront of that.
Yeah, I love it. Well, and thanks for being able to disrupt this a little bit because I think there a lot of people need alternatives that are going to be better for them. Institutional lenders, like old school ones. I don't know that there's so much rigidity there, and there are some concepts now that I just think people could go make a anyway, they can make a lot of money and really enjoy what they're doing, being entrepreneurs, if they can get the funding to do it. So thanks for creating a different way that helps
Yeah.
people to do that.
Quality of life. That helps the people.
Absolutely. Yeah, Ron, thank you for your time. If people want to find you and maybe ask you questions, bend your ear and try to get some advice for their franchise candidates, for their brands, how should people find you? How should they get in touch with you?
You can find me on LinkedIn. You can find our website, jumpstartfinance.com. If you want to email me, it's ron@jumpstartfinance.com. Feel free to reach out. Happy to chat with you, brainstorm if you have questions, ideas. If you're a thought leader and want to just brainstorm ways we can help people, or if you're a veteran and want to brainstorm ways we can help people, or you just need help yourself, happy to chat.
Yeah, you're a good man. Ron, thank you for your
Thank you.
time. I appreciate you lending some expertise today.
Likewise, Dave. Always a pleasure. Thank you.
See you.